Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. We got CPI. We're gonna pull the music up right away. We have had a pretty good move up here in the treasuries, which means, well, I mean, maybe that means I think the CPI number is going to be good, but it also kind of means that if we get hit, it's bad. It's going to be even worse than it otherwise would be because of the way that everybody's positioned. I am going to switch my workspace around here a little bit, if that's okay with you. I'm going to close that other workspace just to give ourselves a little bit extra CPU, because this one really, I mean, I'm hearing estimates that the market could move 5% down on this if the number was bad. So we're gonna, okay, there we go. So I think we got everything set up. And again, the big number that we're listening for is US core CPI month over month consensus expectation 0.4%. And when we do get the number, I'm not going to trade it. I am going to be pulling up the release. Unless, like, I'm really lucky. I guess I'll arm this, put a limit orders. Blow my nose here. Feels pretty intense. I guess I can move this over here. Okay, so there is no liquidity in the micro, so I'm going to turn that off. Okay. Core is spot 6. Core is spot 6. That's not good. That is not good. Jeez. I could actually hit that. Even that. I should have hit it. I should have hit it. That guy that hit that 7 right there at 3.88. Good job. But I think that 935 is about, actually maybe even 95. This is going to be a oh man. Ooh, S&P 500 is already down 100 points. This is just going to be a complete, man. Okay, let's come in here. I'm coming in looking at the crosstab. All items, less food and energy, spot 6. I see a spot 7 rise among new vehicles, which is a little bit of a surprise. Or new vehicles, but used cars and trucks down 1.1%. Okay, actually that is in line with what we wanted. Apparel down, spot 3. Medical care commodities down 0.1%. That's good. But the shelter component, spot 7. Transportation services 1.9. Wow, that's really high compared to previous months. Medical care services 1%. So essentially, the shelter component has not been moved at all. Is really the gist of it. I think I was a little bit of a chicken there. I probably could have put a limit order out, and I mean, am I? Especially 3.8, like we'd be so easily in the money right now, right? And they did. There was people who, I don't know, but I don't know why, but there was people with limit orders out there. What is the shelter component? So we're talking about like the cost of housing. So the way that the CPI, this is kind of the controversial part of CPI, but CPI does not use the price of home sales to determine what its shelter component is. It uses the cost of rent, which tends to lag the new home prices. And so essentially that number is kind of lagged and stubborn and isn't coming down. But as much as the Federal Reserve has done, it has not really moved. So to see that shelter component still be high is not a good sign. And then, you know, to have CPI be spot 6 again, if we just come over to the graph, not core CPI, not the headline CPI, the core CPI, core CPI, right? It's just in line with what it was before. So we're not seeing any impact yet. We're not seeing any impact of raising rates affecting inflation whatsoever. Well, shall we market make here? Okay. Micros are probably still a little too questionable to trade here for me, so. I don't, you know, when I saw that 7, there's no guarantee that if I had hit it, that I would have done it. But I was kind of sitting like, I probably should be cautious here. Like, it registered, the opportunity registered, but it didn't register in my mind to click. So, oh well. That kind of sucks. Look at that. Like, you think about it, it's kind of crazy that we're not. Wow. I could put, like, so if I put some orders out here. Yeah. Let's bid it up. I'm willing to go 395 at least. The robots are in the micros are not there. And the 30-year, like, what the hell? Okay. Well, when you look at this, it's like, wow, that wasn't a very good bounce. Well, it seems like when I look at it in the DOM, it seems like it was a good bounce. But then when you look at it on the charts, it's like, wow, that was not a very good bounce. And by the way, good morning, Mashun. Really, everybody. Man, can you believe this? It's kind of crazy now. You come in here and you look at this, like that there was that the bond market was up before this, right? Well, I think the bond market was up before this because of the UK situation was getting better, right? And that the Europeans had traded higher. But whew, this is such a gut check. It's the equities are just gonna get hammered here. Wow, I'm surprised somebody's actually putting offers ahead of me, huh? Okay. Well, the next question here is going to be, do we see how damaged the liquidity is? Yeah. I'll take another one off there. Nothing I could do really but practice on sim anyways. Yeah. Well, look, see, even though I missed like the easy entry, I don't know if I would have really like again, I'm sitting there. I saw the 7. I could have clicked. I didn't click. I don't know if I had clicked if I would have actually have gotten it. Probably might have been, you know, that I'm too delayed and lagged and it would have missed it. But even with that, okay, so the liquidity is coming back, and these guys are hitting it pretty aggressively too, I might add. Well, let's not count our chickens before they hatch. I haven't taken profits on this runner that I've got, but I'm sure that whoever billed me is kicking themselves. and this is just kind of a situation where I know enough about like the overall curve and the estimates that people are putting out and everything to know what numbers are reasonable, right? So like before, the Federal Reserve was saying 4.5, right? There's no way now. It's going to be higher than that. I mean, November is almost guaranteed to be 75 basis points. And after this, I say there's probably a really, really good chance that December will be 75 basis points as well. In fact, we may have to start considering the possibility of a 100 basis point hike. Okay, I got filled. So the only reason I was able to get away with that, or the reason I took that trade, was because I knew that 3.95 was reasonable, given the prices. I watched it enough to know that 3.95 was good and that the market makers just weren't putting any liquidity out there. So when the market maker turned back in 10 minutes after it went in, they of course came up and got me. So, and then here on my sim trade, I think I can just kind of chill. Okay, well, when things are going well, should I try and push this? Let's give it some time. Xian did not breach its lows yet, and there's a pretty big order at 110.16, so... shorted the December ES contract and went long to March. Guess which one activated? Sorry, this... What? Wait, you got activated. I mean, that trade overall should be a winner, yeah? That should be like a big winner. Oh. What do you mean by activated? This is not a terminology that I'm commonly hearing in futures trading. By the way, I should turn my workspace, my main workspace, back on so we can get a little bit better of a... Oh, you got filled. Well, then good. So you went short ES. You got filled. What price did you get filled? What price did you get filled? You're over. Wait, did you put it in before the release? You did it before the release, you lucky bastard. Oh my gosh, Ish, can you imagine if you had been on the wrong side? How big of a lot that would have been. You know what you should do with that, Ish, is you should cash that. No, I'm dead serious. Of course, I'm not like acting as a financial advisor or anything, but when you get a really lucky winner like that, I think that the prudent thing to do is to cash it. Put it into something safer, because you got lucky. You know what I mean? So what will happen? What tends to happen when we make a big winner like that is we start gambling even more. Wow, how did they fill? What the hell? Okay, so we just saw a 4K iceberg on the bid at 18. Of course, they filled him and went through him. And there's still that big order at 16. I don't think he's gonna pull away because it's 16. So I'm actually really surprised to see any sort of market maker or anyone stepping in and buying here, because there's a good chance that we could see 4.25, frankly, in the treasury. Well, I don't know. I'm actually, so I'm thinking about it now. Oh my gosh. Look at my charts, man. Every single chart is the same thing. Gadoosh. Oh, this is the biggest disaster I have never seen the market react to a piece of news like this. Just straight down, every asset Oh, NQ is down 3%. They were saying NQ could move 5% on the day. I think it's going to happen. I think it's going to, you think that it's going to be 5%? No, this is way worse than last CPI, man. Last CPI was bad, don't get me wrong. But this is way worse. This is, am I wrong? I feel like this is way worse. So I took my profits of 4%. How much further do you think it goes? There's already $30 more. we did have 100 points in a minute. That's true. And yes. Let's go back and look. Now that we've got everything up, let's see here if I can figure out which one of these is my oh, here it is, volume. Okay, so if we come back to ES, I think it was this one right here, right? The 913. Here, let me pull this up. I went to last month. I think it was the 13th. Yeah, it was the 13th. Okay, so we come over here to this chart. The 13th was, oh, it was a 5% day. Okay. So maybe this is just on par with last times. Well, what about in the ZN? 13th. There it is right there. Oh, we're already well past the 13th's range in the treasuries. Maybe that's why the people were stepping in at some of the places that they were, because of comparing the volatility and stuff. Man, oh man. And we are, by the way, at new lows of the year in the treasuries. That was at 19. Same pattern, hilarious. Well, so the thing that I'm wondering now, what often happens in the news like this is, at least in the treasuries, this is not the same in ES, but what I tend to see happen in the treasuries is they will make the big move, and like the low of the day is set shortly after the news, and then the rest of the day is just chop sideways. Given this situation, we're probably more likely than usual to get a trend day. So I'm not going to say that like that's it, but I am kind of wondering if they've kind of reached the extent of their. It's kind of crazy. So I got 3.95. I could have gotten 3.88. So that would have been 2 plus 5, 7. And then you add the 5 that I got. It's 12. And then I could have gotten 3 more after that. So I could have made $150 off of this move. if I had been fast. Well, you know what though? It's okay that I caught a much safer trade, didn't I? I mean, the trade that I caught was actually I'm a little bit more proud of than if I had taken the first one. Because that one was 100% just knowing my market, you know what I mean? So I'm a little proud of that. Based on, well, listen, I think in it, particularly in a situation like right now, just throw your Fibonacci numbers out the window, man. All that matters, literally, all that matters is how many people have to puke. That's it. Now, how many there are, I don't know if there's any reliable way of knowing. A lot. A lot. I was actually thinking about this. So there's been a guy on my price action is garbage video. There's somebody has been having an argument here. Let me read it to you because the guy is not stupid. He's not stupid, right? So I'm actually enjoying talking to him, but I'm kind of holding back on responding to him again because I really want to convince him. Like, I really, I don't know why I think I can, but I really want to convince this guy. I was reading how to win friends and influence people to try and figure out some arguments. I don't know if it's helping, but I don't know, but to try and figure out. Okay, so here's what he said, because I made a couple of replies. I don't know if they're, I think you'll understand the context enough just from reading his comment. Okay, well, let's look at some facts. The market doesn't move on its own. If there's no volume and no action, price will simply stay put. That part is true. Participants in the market buy and sell with intent. They do not roll a dice to decide which direction their position will go. There may be a collective of reasons for any decision, but they are not random actions. So, yes, but they all have their different reasons, is the thing. Okay, but anyways, even market makers who influence price are not randomly acting. Algorithms are not randomly operating on a whim. They too have been programmed to respond to market conditions, order flow, and highly likely the price of the instrument. So if we can concede that the random walk theory is ridiculous, which I do not agree with, and action is based on various goals and intentions, then we can thus start to paint a picture of what is potentially likely to happen throughout our trading day/week. The market cycles day in and day out as it gets overbought and oversold, as people bet on the likelihood of a cycle or a trend, as people respond to economic factors, as large participants and market makers do their job. Once we start to paint a picture of the different types of actions in the markets and their intentions, speculation, hedging, market making, stop hunting, value, price history can show us how this picture plays out on an instrument, and we can start to see them in real time. That was his comment, right? So I have a couple of, like, so for those of you that are already on the train, right? What are some of the fallacies in his comments there? Well, I think the big one is that the people's psychology, because that's really what he's talking about, is he's saying I should be able to look at what's happening in the market and predict what the market participants as a whole are actually going to do. Well, you might be able to do that on a swing. You might be able to do that on a swing, but especially on like day trading, no. What is most predictive of what's going to happen in the short time frames? Well, it turns out that the rules of the market are more explanative of why the market moves the way that it does than market psychology is. Okay, in other words, to be more technical about it, market microstructure has more evidence explaining the market than the what do we call this? Investor psychology, whatever, behavioral. What did they call it? What is this? You know what I'm talking about. And I'm gonna figure out what it is now. Anyways, so like going to one of my favorite studies, the inelastic theory of markets. One of the things that they talk about in that study is that it appears that the elasticity of the market has changed over the years, and that it's gotten more inelastic instead of more elastic, right? So their suggestion was that because index funds have become such a significant part of the market now compared to the speculators, and that has increased the inelasticity of the market, right? So that's why kind of like the investor psychology side of things doesn't end up being really actually very useful, even if maybe there are some things that are true about it, right? Because one, the rules of the market and the actual money that's coming in from, people contributing to their funds is a more significant predictor of where we're going. One. Number two is that because the markets are so inelastic, one market participant can completely dominate things. Just one guy can like completely dictate where things are going. And you have absolutely no idea why that person is trading, right? So you might be able to come in and say, well, the market participants, like in this situation, well, market participants as a whole are going to be really afraid. Yeah, but how do you explain some of these pullbacks, right? Well, has one person decided to get out, or who knows? Who knows? That the iceberging that we had, like the 4Ks up here, who knows? Who knows? There's no, I wish there's, sometimes we can guess, but a lot of the time we can't. And that's why the random walk theory of markets is not nonsense. I mean, it's false, but it's not nonsense. It's actually a very effective kind of default mode to go into that really helps you predict markets to a certain extent, right? Like coming in and using like Brownian motion for options actually does result in fairly good estimates. Buyers and sellers move price, but liquidity, yes. Top Gun, that's correct. I'm being really ADHD right now because I don't feel like that I see, like if I wrote what I just set out to you as my response to this guy, I don't think that it would be a very effective response, right? I think what I want to say to him is I want to say, he says, okay, let's look at some facts. Are those actually facts? Can you prove those things empirically? Because, they might sound like good theories, but we can't say that they're facts unless we can prove them empirically. Well, let's go through the things that he said and let's say, can we prove them empirically? The market doesn't move on its own. If there's no volume and no action, price will simply stay put. Okay, so that we can verify. And furthermore, we can verify that volume is an effective explainer of how much volatility we have in everything. So you can come in after the fact, look at what the volume is, and make a pretty good estimate of how far it moved. Okay, so that's true. Participants in the market buy and sell with intent. They do not roll a dice to decide which direction their position will go. There may be a collective of reasons for any decision, but they are not random actions. So that's not necessarily actually true. Some people think that they are making rational decisions, but I think that the humans overall are not actually all that rational, and that sometimes their behavior can be quite random. Over a large group of people, we should be able to get some behavior. Like if I craft an ad campaign, I might not be able to predict how any one individual person in the group of people that see that ad, I might not be able to predict how any one individual will behave, but I should be able to get a good model of like what percentage of people I'll convince or how many sales I might drive from that, right? From people as a whole, I might be able to get something like that, right? So he says, even market makers who influence price are not randomly acting. So that one I actually take issue with, because that's actually not true. The market makers are intentionally inject a certain amount of randomness into the market so that they can make money. Basically, the price needs to go a certain way. So if all of the orders are coming in as buy, right, the market makers will randomly pull and accept orders in order to create this little bit of noise that they can make money off of. And the reason that we know that is because we've looked, well, or at least that's the theory, And the evidence that we have backing that theory is we made a bunch of models. We made models saying, okay, this person sees something and then they react and then they react. And those models didn't match the market data very well. Whereas when we went in and we said, okay, but what if there was a large meta order? And then when we did that, then we found that it matched the data very, very well. And that the market makers were just injecting noise into it to make money. So that model matched the market data better. That's why we think that that's the case, right? So it's not crazy to say that the random walk theory is ridiculous, because even though the random walk theory is false, it required a great deal of research to prove it false. It was, in fact, the leading theory about markets for several decades, and until we got into the 80s. Random walk. So the random walk theory is the theory that price on a short time frame, it literally is just random, and that there's no way to explain it. Okay. Now, what we find is that there is a lot of randomness to short action, but it's not because it's just purely random. It's because there's so much going on that it's difficult to explain all of the things that are going on. And so from that perspective, it might as well be noise, right? But then after large amounts of research, we were able to find certain statistical properties of the markets that were different from if it was just a purely random walk. For instance, volatility tends to cluster. When you have one big volatile event, you tend to have more volatility around that. That is not what you would expect if the market was purely a random walk, right? So we know that the market is not a random walk, but it's a major component of it. Let's say, right? And we call them stylized behaviors, these kind of statistical properties of markets that are different from a random walk that we do have are quite limited and complicated to explain often, right? So the whole thing is that if you think that we can come in and we can look at painting a picture of the different types of actions in the markets and their intentions, and look at it with price history, we can show how this picture plays out on an instrument, and then we can start to see them in real time. Okay, so if that's true, then we should be able to make a model that explains, that explains that and use it and show data that shows that it's an effective model, right? But nobody's been able to do that. That's what everybody's trying to do, and nobody's ever been able to make that model. Why is that? Well, I'll tell you why. It's because markets are inelastic. Orders have extreme impact on price. And so the actions, like taking the group as a whole to try and see what's going to happen, is not a very good predictor of what is actually going to happen. Because one person in there could cancel all of that out. And the reason that he's trading, as far as we can tell, is random, right? Of course he has a reason, but there's no way for us to sort out what it is. That was a pretty good stop run after a big iceberg there at 09. So they are pushing a little bit further. So there's now $50-$60 that I could have had extra if I had stayed in. Jiffo, I already took my trade. I'm now to the point where I'm just terrified to touch it. So that's probably so the thing is I had a couple of losers the past week. So this trade that I took cancels out all of those trades and then some, and I'm happy with it. So I don't need to push this as high, but I know that the pullbacks on this are really nasty, and I haven't seen anything yet that gave me a really clear, like, let's go for it here. Although that break from 09 down to 04 sure looks nice, doesn't it? But I still have this sim trade on, right? I'm just gonna let this sim trade run now, I guess. I'll just close this one at the end of the day. Anyways, so if one big trader can dominate action on a short time frame, then that kind of explains why you get back to this random walk thing. But then it also explains why like the market microstructure ends up being a better way to explain why the markets work. Or the market microstructure ends up being more predictive, right? They're super tiny little rules and stuff, but they explain a lot of interesting things that go on the market. But the whole point of all of that, because Captain Price was saying fib numbers and all of these sorts of things, the whole point of that was the data that we have says that using market microstructure is better at explaining and predicting market behavior than market psychology is, right? And so the whole Fibonacci number, especially in this kind of a situation, Fibonacci numbers probably aren't going to be very useful to you, right? What's going to be more useful is what? The rules of the markets. And the way that liquidity works, it creates liquidity holes. And that's why we kind of get these gasps up and then pushes lower. So even though there's probably not a soul out here that thinks, oh man, this CPI, everybody's really misinterpreting it. This is a great buy opportunity. I want to buy as many treasuries as I can here. That person does not exist. There is nobody on this instrument that is thinking, oh man, I really want to buy this here. No, not a single soul. So then why do we get those pullbacks and stuff? Well, one, people do take profits. I took profits, right? Two, the structure of the market. It creates these liquidity holes, and when you get a liquidity hole, you kind of create an area where you're likely to actually slip back into where you just came from on very little volume, just because nobody's market making on that side. Or there hasn't been enough time for the market makers to come in and hold it. Although I have to say they're trading 05 half 06. So 1,731. Okay, so that one was only 170. So they might slip all the way back up to 09. Really, no one wants to buy? Maybe someone wants to. I mean, nobody's saying that CPI was actually better than people thought. That's what I said, right? This is one of the very, very few situations where you can look at that number and you know almost exactly what's going to happen, right? And the whole game here is catching it somehow, right? But it's not so easy, is it? Because you get these pullbacks that are just crazy. Like this first pullback, oh man. The first pullback was 32 ticks. No, 29 ticks. Almost 32 ticks. Right? So the first pullback, $500 on one Xeon contract. If you had eaten it, right? That's kind of the problem. That's how extreme the liquidity holes end up being in this kind of a move, and that kind of makes it a little bit difficult to hold risks sometimes. I really shouldn't have gotten out at 4% though, did I? I just said my entry was 3.95 based on what I knew the numbers to be, and I knew that 4% was a place that we were likely to get above, but I really could have just continued to hold it and read the order flow like I usually do, or maybe I should have done that and I would be up 110 now. Jeez, isn't that crazy? But really, if I get $50 in a day, I should be happy with it. that was the other thing, is $50 is kind of like my okay. Like if I get $50, I might not necessarily have any reason to continue trading. Yeah, I could have traded this, but I might have like gotten scared and like gotten out, or things like that. Like a big bid at 05. to me is kind of like, okay. Maybe it's time to take profits. Actually, well, but we've got 110 below us. Tell you what, I'm going to put my limit order right here at 110. Man. CPI, we should change the title. CPI disaster. I want to come in and make like this. I always want to be able to make this statement that it's like the way that I say it, you see what I see, and all of a sudden it's like, oh, you're right, Seth, of course. All of these things that I thought before, now I understand why they were kind of silly. Not that they were silly, but like I understand why maybe they didn't matter, and why what you're saying is like so much better of an explanation of what happens, and is so much more useful to me. And I think that is the case, but I just don't know how to say it to you guys to make new people understand, you know? I don't want to make people do it. I mean, because everybody in here is trying hard. Everybody has something. Listen, everybody has something to offer to the market. I think that we want to sit here and think. I think that's like one of the big fallacies that we make as traders, is we want to think that we're irrelevant, or like we're prone to think that we're irrelevant, but you're really not. Like that's the encouraging, that's the amazing thing that we learn from the structure of the markets, is that actually everyone does matter. Every participant's actions have an effect on the market. And there are some situations where one order can like really change things. If you were to reload short, would you do it at 09 or 13? So at this moment, I don't think that I would be looking to add positions, because it looks to me like the market has reached the extent of the impact that they can have. In other words, the liquidity is just a little bit too crazy for, you know, this 09 area where there was that big order. We're really likely to start rotating around that now. Now, when we saw that big, you know, the 8K on this side and the 3,600 on this side, right? And then we pushed through it. If you had a stop order at like 09 or 08 half, you know, to get stop limit order to get filled there, and you had somehow gotten filled at 09, that would have been a great as she goes moves. But I didn't know when I saw this that that's what was going to happen, right? But, you know, you could have maybe made something on those, or even 13, or even this one, the 16 one, that was one that maybe it would have been able to justify going short there. But I digress. Yeah, we're getting into the choppy area where it's like, if you're going to take a trade, like maybe I want to take a swing trade here because I think that tomorrow it will just keep going, and it'll just keep going, right? I'll just make sure you get a good spot within the range. It would probably be above 09. Right? Thanks for the insight. Well, thank you for participating and asking good questions, guys. Now, what are the odds that we just range for the rest of the day in ES? It's actually a good question, because we have been pretty sideways since the initial move in the S&P 500, haven't we? Surely when we open there will be some selling though, right? By the way, one that we haven't said anything about, Bitcoin. Bitcoin dropping below 1800 briefly, which is the lower end of this recent range that we've had. It's pulled back and it is above it for now. Wouldn't surprise me to see more liquidations. But it's like that across the board, man. Now the treasuries, we've seen net 30,000 contracts of selling in the 10-year. Wow, almost 20,000 contracts short in the 5-year. So I could be wrong, but I think that the treasuries have had a pretty decent move. There was actually a lot of people talking when I was going into this market microstructure stuff, and I just feel like that my brain's not all there. I don't feel like I did my job for them there. What do we know, guys? Here's the things that I'm trying to get across. Okay, 1, the market is very statistically efficient, but not very informationally efficient. Okay, so trying to see a pattern, it's really hard to find a pattern that actually works compared to just using the information that we have and knowing, oh yeah, 3.95 is like way too low now, right? Based on what we're projecting for terminal interest rates and stuff now. Okay, that's the first one. The second one is that when we're trying to understand why the market moves the way that it does and possibly predict short-term moves, the market microstructure of the market has been shown to be a more effective guide as to why it behaves the way that it does than market psychology. Okay, when we look especially on short time frames and we try and use market psychology to explain movement, what we find is that people are actually quite random. that trying to judge what the group as a whole is going to do is actually really hard because people are just very, very random. Now, when we have an informational inefficiency, then it's a different situation, right? And we can come in here and we can say, okay, in this situation, everybody's going to sell. We can predict the orders are going to be sell orders. Simple. But that's not using the chart or anything to make that determination, right? That's looking at what the CPI was, following the markets, and knowing how people are going to react to that particular number, right? That's what I'm trying to get out in most succulent way possible. I was trying to be elegant and like, oh, you'd say it in a way that would like really, but I think it kind of fell flat. I'm sorry. I apologize. But you know what? My audience tends to be pretty smart and you guys usually get it anyways. Trading is an edge game. Well, yeah, that's a good way to think about it. I always try to think of it like this because when I first started trading, I was like, hey, I can see patterns that other people can't, and I can, you know, I can see really complicated, nuanced stuff that other people miss. That's all true, but it didn't help me. You know, I would do okay for a while, and then I would like blow up. And now, hey, I don't do well all the time, but now when I do well, I'm getting way more out of the when I am doing well, and when I'm not doing well, those drops are much more measured. Okay. And how did I do that? By focusing on the informational inefficiencies out there. And I always ask myself, do I know something that is not priced into the market that has a really good chance of predicting what the next set of orders are going to be? So I think of it like I'm on the floor. If I'm on the floor and I'm a famous person on the floor, okay, everybody's looking for me, okay? That can be an advantage, right? Because you have other people following you. You take a trade, other people might trade after you, and that could maybe help. Because if they think you're a good trader and stuff, and they want to shadow your trade or whatever, right? And that happens, and that happened on the floor a lot, right? But it also means that there's people gunning for you. Like, have you ever seen the movie Liar's Poker or whatever it is? Is that what it's called? Where this girl learns, starts a poker game. Liar's poker. Molly's game. That's what you're right. That's what it was called. Molly's game, not Liar's poker. Liar's poker is the book. In the movie Molly's game, this girl, she starts a poker game, and there's this one guy that was really, really good at playing poker, and he was always winning money from everybody. And then one day, the worst player in their poker game beat him on this setup that he's had trouble with before. And the guy like just completely loses it and goes on tilt. And when he's on tilt, some of the other people that had lost money to him were all, you know, jumping in, wanted to play so that they could play him while he's on tilt and get their money back, right? So the same thing happens in the market. If you're the person that everybody's watching and then you're on tilt, you're doing bad, they're gonna rail you for as much as you can, as much as they can, right? So being the person that everybody's watching can also be a disadvantage if you start to get in a losing position, because they're gonna squeeze you that much harder. And you know, because they know that when you exit, that, you know, they can get their fills and they can take a lot of money from you, right? So I'm not going to take a trade unless I think that somebody'd have to be dumb to trade against me, knowing what I know. That's how I think about it. I don't want to take a trade. I you know, other people are watching me, so I don't want to be taking a trade unless I think that trading against me would be really dumb in that situation, right? Because one person could move the market against me. It's possible, for, not that it happens or that I think that it happens, but it's possible for one guy at an institution to be like, oh, I don't really like Seth and I want him to lose money. So I see that he just got into a position. I'm going to move the market against him a little bit to try and scare him out, right? I want to be taking a trade in a situation where they would be dumb to do that. They would say, oh, I'm going to push the market against them to do that. And then somebody else is going to take all of those fills and slam it, right? And he'll be stuck. It's a situation where you got to be dumb to trade against it. That's how I think about it. So now it starts dropping further. Stupid ES. I was short 2 MES after the initial drop and only managed to get $90. You took the profits on it? It's okay. Like, so I struggle with this a little bit because I do feel like I'm a little bit too risk averse sometimes, right? I think in this situation, it's kind of saying, Seth, you should have held on. You should have pushed it. You should have pushed it as hard as you could. But yeah, I mean, and I think you're probably a little bit like me in this respect, Kevin. Not that I'm saying this is your personality or anything, but it's just we've been around for a long time, right? And I think that we can both think of times where we saw a move like this and we thought, oh yeah, so I just go short here, right? And then yeah, it was right. Like overall, we did move down, but you just got a bad position, or it came back in your face, or you know, you didn't take your profits early enough and so you lost a lot of your profits. That's, you know, like you just know that in a market like this that it can rip your face off even if you're the right direction, right? So I don't think that there's any shame in taking a quick winner. There's really not, because again, like if you can get in at the beginning of the move, then it's easy. You can just kind of hold it. That's why we sit here and we look at this and it's like, I could be up, you know, $70 more than what I had, right? Well, okay, but now if you take a trade right here, right now, guess what? It's gonna be hard, right? And if you had taken a trade anywhere here below 09, you've been taking some heat, right? Shall we long for the? No, I don't think I want to touch it. That's what I'm saying. That's what I'm saying is that at this point, even though the most likely scenario is that the S&P 500 continues to move down and that we have a negative 5% day in the NASDAQ, getting a position where you can hold the risk is hard. And so if I don't already have a position on, it may be better for me to just stay out. Right? This is why, for instance, on my sim trade, I'm just letting it run and I'm not adding contracts. Right? They came just shy of my order. Well, that 110 even is close enough down there. They may yet go for it, but it could be a while. Might be smart for me to just try and take a profit somewhere around 04 or 05 half and just say $1,000. That's fine. Okay, now that's weird. Am I missing something? Because I'm noticing a spike in the Japanese yen. So this is exactly the sort of thing. Okay, USD JPY stomped down, but not for long. JPY. Okay, so this is exactly the sort of thing that I'm talking about, man. There might be some intervention coming into the Japanese yen here, which if it is, could cause. So you know what? Well, it's actually 982 is a lot to trade there at 07. Okay, I'm gonna get out of that position because I'm scared now. No, Oliver. Let me be clear. I'm speculating that there could be. Okay. This is all we know. This is all we know. Look at the chart of the Japanese yen here. Look at this chart of the Japanese yen. Ooh, we had the big move down, but now in the last 5 minutes there was a spike that took us above the pre-news price, and now a little bit higher. Okay, so that would be the sort of thing that would happen if the Japanese yen was seeing intervention, but there has not been any news headlines to that effect yet. So we're just speculating. This line right here, though, you see this big blue line way up here at the top? That was the line where the Japanese first did intervention like 2 or 3 weeks ago. Okay, so like we're well below that point. So yeah, really good chance that the Japanese may be involved here. And that means that I got to be extra careful about trying to go short in the treasury, right? Now, does that mean then buy it? If I wanted to make that trade, then I would buy the Japanese yen, right? I would buy 6J, not the 10-year. Did all their intervention go to waste? I think that that's too much of an opinion for me to answer your question like that in the affirmative. I think that that'd be too much of an opinion. I feel like that it's a waste. Yeah. I feel like it's a waste. I think that Japan needs to raise rates. Like, I think it's going to be painful, but I think that what we see from Japan is that holding interest rates low for so long is not actually good for economic growth. That reducing rates in the short term is good, but that long periods of abnormally low interest rates leads to slower economic growth, and it causes people to have less children and to feel like they have to save up more for retirement and things like that, and it's actually quite toxic to your society as a whole. I think that the sooner the Japanese can get off of forever QE, the better. That's my opinion. If they raise the interest rate, they will never pay off the debt. Well, are they ever going to pay off the debt anyways? You know? That's kind of, I mean, so it's on that point, it's more interesting to think about that one from the perspective of the United Kingdom, right? Is it make sense for the United Kingdom to just take on more debt here in the short term, even though it's like inflationary and everything, to shore up their economy? Because otherwise, if they just get, let's say that everything stays the same as it is, the UK doesn't increase its deficit, okay? And all of their current intervention works out and everything, so that was the end of the story. I don't think it's going to be, but if this was just the end of the story, like, what's the trajectory for the UK in the long run? And from the information that I just kind of shared, it kind of suggests that the UK could see below trend growth for a really long time, right? Is it worth taking a little bit of pain right now so that you can have better growth in the long run? That's the question. But like, here's the thing. The central banks won't let them do that, right? Like what really happens here, or like the way that this ends and you get out of that loop is you inflate the currency. You let the currency inflate and you take the pain caused by the inflation, and then all of your debts are inflated away and you can kind of start again new, right? But because the central bank's directive is to ensure maximum price stability, that's not going to happen. Right? And of course there's the whole, well, okay, but if you do let the currency inflate and everything, like, that might be the end of your country. Well, there's that too, but you get what I'm saying? Well, that's what the US is doing. I don't think that that's what was intentional. But yeah, some of the debt is being inflated away. You're right. I have to say, like, there's a couple of different takes that people have in relation to central banking, right? On one side, you got these guys that tend to be incredibly conservative. They think that we should move back to a gold standard. They always want interest rates to be high. But what they would really like is for the Federal Reserve to just not exist anymore, right? That's the one side. And then there's this other side on the left that would like to give, like, complete control of the economy over to the Federal Reserve. And even then, frankly, they would like the bureaucrats to have complete control over the Federal Reserve. By bureaucrats, I mean like the politicians, rather, right? And so you're kind of always stuck between these two sides. And so whenever something happens in relation to central bank policy, you always get these people saying things that aren't really backed up by any kind of real evidence. It's really more a reflection of their general take on the political ideology. So if the Federal Reserve comes in and makes a monetary policy mistake, the reason is because they're intentionally inflating the monetary supply to screw us all over, right? That's what a group of people will come in and say. It's not true. What really happened? Well, what really happened was that the Federal Reserve has to look at risks. And so they can come in and they can see that, okay, maybe the economy is doing really well right now, but we have this risk, which is another COVID wave. And so we judge, because of that risk, that we shouldn't be too hasty to raise interest rates. Okay, that's the decision that they made, and it was made on, it was a risk calculation. Okay, so it's totally correct for them to make a risk calculation. What was the mistake that they made? Here's the mistake that they made. The risk of inflation to the economy, it turns out that the risk of inflation is a more damaging risk than the risk of a third COVID wave. That's really what it came down to. So inflation was worse than a third COVID wave. They made that calculation and they were wrong. So should we hate them for making that mistake? Yeah. Like, I don't see them make that mistake and say we need to change their framework. You know what I mean? Just means, well, we learn. We learn inflation is really nasty. You really don't want inflation to take hold, right? Now, in terms of the other countries playing or match fixing in game theory to inflate the USD, well, I think that really comes down to that for the past 20 years or so, other countries have really enjoyed a lot of growth, frankly, at the United States' expense, right? We set up rules that encouraged people to take money overseas to some extent. And Europe in particular was getting a really easy ride from the United States. They have a lot of social services and a lot of debt that they were really only able to do because the United States was paying for their defense and they were, you know, relying on the United States' strong economy. And then when we come into a situation where the economy is growing weaker and inflation is coming out, that just completely falls apart for them, right? Now, what do they actually have to do in Europe? They have to raise interest rates probably more aggressively than the Federal Reserve, right? And they have to show more fiscal restraint. And the problem is that the Europeans have lived in this for such a long time that the politicians don't get it. They don't understand what's going on, and they come in and they see the things going on, and they're like, okay, well, we'll just pay all of the heating costs for everyone. They don't understand how big of a problem that is, right? So the politicians don't get it yet. Certainly not the ones in Europe. Well, and certainly not Joe Biden. Right? Jeff Snyder doesn't agree. I honestly, I don't really give a shit what he thinks. No offense, Jeff, if you come and see this. It's nothing personalized. I think that he says a lot of things that are not empirically backed. So the Ben Bernanke thing. Can we talk about the Ben Bernanke thing? Because I think it's funny the way that the internet reacts to the Ben Bernanke thing. Listen, the research that Ben Bernanke did was valuable, important research that changed the course of financial history, prevented a Great Depression, and is absolutely every bit deserving of a Nobel Prize. Even though it's not a real Nobel Prize, apparently, and all that. And yeah, did Ben Bernanke kind of cause the crisis? I think so. That's not a part that I've studied too well, but from what I understand, some of the policy decisions that Ben Bernanke made going into the crisis kind of made it so that we ended up getting a real crisis when he really could have looked at the market earlier and done something earlier and not been so aggressive and all this sort of thing. So is it fair that he to say that he was a contributing factor to creating the crisis? Yes, he was, but he still deserves a Nobel Prize, man, because he did the right thing after it happened. Yes, stimulating the economy and printing money so that you get the money flowing again to prevent a Great Depression was the right thing. I know that so many people, especially on the right, hate that, but that's just what our best understanding of the market says that you do right now. If we hadn't have done that, if we had done what the right wingers want, then it would have been a 10-year Great Depression. He Jimmy Neutroned it. There you go. That's exactly it. Makes us screw up, causes the problem, and then ends up being the savior. Yeah. Here's why I say what I do about Jeff Snyder. Jeff Snyder has a theory about how monetary policy works and the Federal Reserve works that is not, that you can't prove, right? So he says that what the Federal Reserve does doesn't actually matter, that the banks actually are in complete control, and that they can come in and do Xing. So I guarantee you what he's going to be saying after this CPI report is he's going to say, see, look, the Federal Reserve has raised interest rates and it hasn't done a darned thing, hasn't affected inflation in the least bit, etc., etc. This shows that it's all just a game, that the only reason the market reacts to the Federal Reserve is because they think that it matters. But in the end, their moves that they make don't actually have any impact on the monetary system. That's what he's going to say, right? How do you prove that? How do you prove that empirically? You can't. Like, that's the whole effing thing, is that you can't. And it contradicts like everything that we know about monetary policy. I would argue that, look, when the Federal Reserve comes in and sets the federal funds rate at 4%, that has a direct impact on what the banks can do, because basically it means that there are certain deals that they can't do now. There might be some billionaire that wants to acquire a new company and then grow that company, for instance. Okay, so he will have to borrow money to do it. He will have the bank will have to borrow money to do it. But oh, guess what? Because the interest rate is now 4%, we can't afford to do that. So that transaction doesn't happen. And that's how the Federal Reserve raising interest rates slows the velocity of money. It has a direct impact on what they do, because there are transactions and so forth that they simply can't afford anymore. And that's the way that the Federal Reserve works. That's actually like the beauty of it. Because as much as we complain about it being a central bank, the system is as decentralized as you could possibly make it. Because the thing is you have to have something that's countercyclical, right? When we're in a recession, you need to have something to be able to come in and stimulate the economy with. You need something where when you're losing money on stocks, that you can go into this other thing and make money from it, right? So there has to be a counter-cyclical mechanism. And the only way that you can do that is by having a government come in and say, well, we can buy as much of it as we need to, sort of a thing, right? And to set the interest rate. But they don't want to take over the market. They don't want to be central planners. So what do? They do it in a way that is the most decentralized, free market way that they can while still accomplishing their goal. So what do? All they do is change the interest rate, and the banks are still responsible for allocating capital, right? So if we lower the interest rate, now there's all these transactions that we wouldn't otherwise be able to do that now we can do. But guess who decides where that money goes and who those loans are given to? The banks do. Because when the banks make loans, that's when the money is created. Okay, so that's another interesting thing, is this whole like fractional reserve theory of money. That's not how it works. The banks literally have the ability to create money. They go in and they create a number in a spreadsheet when they make you a loan, and that creates money, right? So that's what we understand about monetary policy, and this whole thing about like that the Federal Reserve changes interest rates, it doesn't actually change anything, is just like, okay, prove it. But it's not going to be too useful to your trading, right? Because what's useful to your trading is predicting future orders, and yeah, what the Federal Reserve does is very effective at predicting future orders. So that's why I kind of, and he's kind of popular, and I really don't feel, I think that he says things that speaks to a certain group of people politically, but that there's no real solid empirical backing to what he says. That's why I'm a little derisive about him. I'm not trying to, I'm sure that It's not like I hate anybody. Just, you know, if I really hate somebody, then I'm just gonna straight up tell you, right? I disagree with this overall framework. And my overall framework is that we should base our understanding on an empirical understanding. So our empirical, there was a study about this where they went and they tracked it. Our empirical understanding is that the banks create the money, okay, but that the interest rate that they have affects how much they're able to actually make. Now, is that what's going on here in this instance? If they're saying that? No, I don't think that that's the case at all. I think that you can see very much so in some of the leading economic indicators that the Federal Reserve raising interest rates has indeed slowed down the economy, considerably so. Okay, so why is CPI still high? Okay, so I think that there's a couple of things that we go going through. So this is probably the most important stuff that we can say. Oh, see, look, I lost a couple of viewers just before the important stuff, huh? So what are some of the reasons why inflation continues to be sticky? Well, here's a couple of thoughts. One is that the key component of the core CPI that we're seeing that remains high and is keeping these numbers high is the shelter component. Okay, so the shelter component, rents lag housing prices. So housing prices coming back down, you might not see the rent prices come back down for a while still, right? Because it's very, very lagged, and that's like such a huge component of the thing. Personally, I think that the way that they calculate shelter is a little bit flawed. I think that we could maybe do better there in that respect. I think that the price of actually buying a home like does matter to core CPI, and that it should be factored in there. Okay, and that if you're going to look at rents, that you need to have a metric that's a little bit more responsive. Okay, because otherwise everything that the CPI is telling you ends up being late, right? So that's one factor that's going on in here. Okay. Another factor is that any changes in general that you make to interest rates and slowing the economy is lagged by about 6 months. So it's only been about 6 months since we started doing like the more extreme rate increases. It might not be until the end of the year. Might not be until January that we really start to see CPI, you know, an impact on CPI. By the way, I'm still seeing maybe some bullish action in the 6J that we got to be aware of if we're going to be in the treasuries here. Okay. Anyways, so yeah, CPI is just a lagging indicator in general. That's another thing. But then the last one, and this one is the most speculative, but it's the one that keeps me up at night, is do we have a naturally tight labor market because of baby boomers starting to retire? And because of what companies have done for a long time. Is it the case that because of the current state of the jobs market, that inflation is just going to be really, really hard to tamp down? Because they've basically, what's been happening when you look at the allocation of capital is people at the top of the pyramid are making more, relatively speaking, while people at the bottom are making the same, if not less, than they did 50 years ago, right? So it's been allocated differently. And maybe that's part of why we haven't had many inflation problems for a long time, right? But now that we're having them, I kind of think that part of what might have to happen here is that the money kind of has to come back down. And how do you do that without it causing inflation? Well, you can't. You can't. And you just kind of have to deal with it until things come back into balance, or you have a recession. Basically, you have to have a recession. You can't do it without having a recession, essentially. And the whole thing is that in order to create that ease in the labor market, you might have to have a deep recession. That's why it keeps me up at night, right? So feel like it's a little to do with politics. I think, or you meaning to say that it has a little to do with politics? Because I think it has a lot to do with politics. I really do. I really think that for the vast majority of people, when they comment on the Federal Reserve, that their comments reflect more their own political theory than it actually does anything about the actual market itself. Because most of these people, their comments are really based on how they feel about the Federal Reserve, right? If you hate the Fed, this is the thing that I think is so funny, is if you're a far right winger that thinks that the Federal Reserve shouldn't exist, right? Then it doesn't matter what the Federal Reserve is doing, you hate it. He doesn't talk politics, but I'm telling you that the whole theory is politically driven. Well, let me put it this way. If the theory isn't based on data and something that we can empirically prove, then what is it based on? Right? It's a theory that you come to because of what you want to believe about the institution itself. That is maybe a conspiracy theory, but it's not empirical. That's the thing that's not a conspiracy theory, is that his theory is not empirically backed. That's my main point, right? I mean, not only is it not empirically backed, but I think that it causes people to make incorrect, it causes people to misinterpret what's going on. I mean, you see it on every end. Like, really, when you come back to, like, how did the Federal Reserve make this mistake? Well, I think that a really big part of why the Federal Reserve made this mistake was because they deferred to the politicians too much, right? The Federal Reserve understands that monetary policy is meant to support fiscal policy, and that they have to work together with the policymakers to make all of these things work. And the Federal Reserve knows that I can't come in and say, oh, he's a Democrat president, I'm not going to help him, etc., etc. Like, you work together with them, and whatever it is that they're doing, you have to try and support it in the best way that you can, right? But this was a situation where the best thing that you could have done to support them was to say, hey, this new bill that you're doing, probably going to cause inflation. Probably we're going to have to raise interest rates. Just warning you. Like, this is what you should know. Maybe you shouldn't do it. And be public about it, so that the public holds their feet to the fire. And, you know, because what's happening right now is, well, the thing that's funny is a lot of the politicians, they said, oh, inflation is transitory, that's why we can pass this bill. And that's how they convinced Joe Manchin to be able to do it, right? So now they want to turn around and say that it wasn't their fault. Well, it's kind of hard for them to argue that, isn't it? It would have been even more difficult if the Federal Reserve had been the one that was warning them, right? So that's why I say I think that the most useful thing that you could have done was that. But that's kind of why we're in this situation, right? Because the politicians want to believe that they can print money forever and it's never going to have any adverse effects, right? So it's political either way. I think it's a little bit what is the word here? I think it shows a lack of self-awareness to suggest that one's opinion on monetary policy is not affected by their own political opinions and underlying feelings about the Federal Reserve. Oh, Hawaiian Dog. Oh yeah, I remember you. Thank you. After watching you live stream in a long time, I finally make good money on the market. Oh man, you made a good win today too. That's good. Couple of you guys made money. So none of you lost big, right? Really, I really hope if you lost big, you're doing something wrong. If you lost big today, you're doing something wrong. You're still in long from 03? No, you're not. I guess I don't understand. You're saying that you took a long, like 30 minutes ago or whatever? I guess if you got like 3503. No, I don't think you would have gotten that. No way. That's that is a price that I think you're gonna have to provide proof to, if you want me to believe. I mean, it's possible. About 2,000 contracts did trade beyond that price. Well, you're long since... Okay, that's different. If you're day trading today, though, and you lost, then we got to work on some things, right? Now, if you didn't take any trades or you break even, that's a different thing. Or if it was a small loss, that's a different thing. Because maybe you just got caught in the chop afterwards. But if you took a big loss, then you're probably doing something wrong. Treasuries were able to come all the way back to 16, but maybe starting to roll over a little bit again. You're long. It was still bad to stay. What are you long? Oh, man. You just long equities? I mean, here's the wild thing about all this, right? Is that it may be that next month is when the CPI comes back. Now, CPI for November comes out after the Federal Reserve meeting. Federal Reserve meeting is at the beginning of the month this time, which is a little weird. So that will happen before the November CPI. But maybe that CPI is when we see things come down. I think that would make sense. Although I think that I really need to see a lot more research now and see like what the next steps of the research people are saying. Because this inflation is being real sticky, isn't it? So there was another theory about this that I meant to share that I had kind of forgotten about. So there's actually four things. The fourth thing is that there is some debate as to whether it is the change in interest rates or the absolute level of interest rates that affects the that slows the economy down, essentially, right? I can actually see when I explained about how the money works and everything, right? That percentage number really does affect how much money the bank can lend out and stuff. But it's also the change. The change, because the economy reacts to the Federal Reserve doing it, just the change itself also has an impact. But given all of that, it's a reasonable theory, and I really don't know the case, and I don't think I've seen any evidence, suggesting that it's one way or the other. Just maybe I'm a little partial to this idea that to really stop inflation, you do have to get rates to a certain number, and 4% is not high enough. That could be the other thing that's going on. Elon Musk, he was lucky that he something and get his shares sold. Elon Musk was lucky that he sold 10% of his Tesla stake at what was essentially the highs. Yeah. Yep, he was. Absolutely right. You know what, though? It may be the case to some extent that him selling his shares might have been part of what caused the market to roll over. Of course the market would have rolled over anyways, okay? But the market rolling over at that particular point, I think that because Tesla's a big part of the index, I think that it's no coincidence that him exiting was part of that, right? Because he basically took a lot of market cap out of the market. I don't know what he did with it. Did he put it into other companies? Is it sitting there in cash? Can you buy more companies after that? I don't know. I do wonder. But that's the way that it goes, right? Your orders have impact. Wow. So this is coming back really hard. So all of this noise that I was saying earlier about, like, well, we kind of know that these sorts of things can screw you over somehow, and that sometimes some really unexpected things happen, or you just get really big pullbacks and you can lose money off of it. So that's why it was good to make the one trade that I did then. And yeah, probably should have pushed it harder, but then, like, look, if I had taken the trade and I was still in it at this moment, I would only be making $30. Be making 20 less than I did, even though there was like a potential for 70 more that I missed out on. Yeah, so Ray, there was some members of the Fed that sold their personal holdings at the top and all that sort of thing. I think that one really is just a coincidence, because the timing of them getting out was not like, oh man, okay, now I really do need to sell, so I need to know. They were being, basically, there's this group of people out there that want a what are the activist Federal Reserve. There's a group of people on the left that want an activist Federal Reserve, and intentionally did things to try and push out members of the Federal Reserve to try and change the composition of the Fed. The issue is that the way that the Federal Reserve acts, I think, has a lot more to do with our understanding of monetary policy rather than the political leanings of the members. Like, the Federal Reserve has been, at least as of recently because of Donald Trump, tilted to the conservative side, but the decisions that the Federal Reserve made is not the decisions that I think you would have made if you were making the decisions based on your conservative ideology, right? They really are very much data driven. It's data driven, and the part that's discretionary for them is how they weight the risks, right? Identifying and weighing the risks, that's the discretionary part. And for the discretionary part, they kind of leaned left, which is interesting. So I think that one's probably just coincidence. But at the same time, it was a real shock to me when I learned, and I mean, I learned this a long time ago, but when I worked for the bank, okay, because I worked for Goldman in technology, and the bank that I worked for are like the most strict on this sort of stuff. Okay. Like, if you make any kind of investment, you have to hold it for at least 30 or 60 days or something like that. Unless you lose more than 10% on the asset, then you can puke it. Right. And you can't trade futures. You can't trade Forex. You can't trade Bitcoin. You can't, none of this sort of stuff. You can do some things with options, but you can't buy options that are going to expire, within a week, sort of a thing. So it's all set up. You just cannot day trade, and they're so strict. You want to buy or sell something, you have to get clearance first. It can't be any company that we've worked with for the past forever, which like really limits you, because they work with freaking everybody, right? and the best companies are the ones that they're working with too, right? So it really limits what you can invest in, right? And then to go in and find out that the Federal Reserve, the ones that would have like the strongest conflict of interest, are allowed to do whatever the heck they want, is just absolutely crazy. So I'm glad they fixed that. Glad they fixed that. Okay, I am seeing the 6J kind of. Am I actually? Hold on. Yeah, okay. I thought maybe the 6J was rolling over and down, but it's not. It looks like the 6J did its thing and the Treasury is now kind of back to what it was. So. You know what? I had a big spike in viewers today. We actually got up to almost 40 viewers at 35 at one point. But we lost them. I guess I'm just too boring, guys. I think that if we want the stream to be like, you know, have 50 people regularly, there's some change that we have to make, and I don't know what it is. Because I've seen channels with like hardly any subscribers and get like lots of viewers on YouTube. So, and we get a decent number. I mean, we're getting like 200 views plus sometimes. They just don't stick around for super long. Am I that boring? Could be the case that the subject matter really is just boring. But I feel like that maybe there's something I gotta do. The Fed said a couple of times first, yeah, yeah, I remember that. I remember that. Is there any useful correlation between 6J and equities intraday? It's kind of a little bit complicated, right? So there's a very, very strong correlation between the 6J and the treasuries, okay? And between the 6J and the dollar, right? Now, there are correlations between the dollar and equities, and there are correlations between the treasuries and equities, but you're kind of talking about like one removed from it. So if you're trading equities, I would certainly have the 6J up and keep them up there, but I don't think that I can sit there and say, oh, well, because they're buying the 6J, I want to buy the S&P 500. It's just, I might want to keep in mind. If I saw a move and, oh, okay, these things move together, maybe that tells me something about why it's moving, right? First time viewer saw your programming video from 2019. Oh, thank you. You know what? I have the first programming video that I made, I think it was, that it continues to do well. And I'm so like, what, really? Why that one? It's, you know, sometimes we act like the algorithm is like omniscient or something. I think that there is still a large degree of inefficiency. Okay, so yeah, it's the one that's like the programming basics one. Ended up being like one of my most consistently good videos. It gets over 48-hour period, 50 videos every 48 hours. The one that does the best is my trading computer hardware one, and I get about 120. Well, in the last 48 hours, I've gotten 120, right? Yep, the basics. Oh, you didn't come in on that one. You came in on the data structures one. That's cool. The data structures one is the one that like, I don't think people use it. like I came in and I showed people like, here's how you make all of these indicators, but I don't actually, I've never seen somebody say, hey, look, I made my own volume profile indicator with the stuff that you taught. But that's what that was about. But yeah, it's interesting to see here. Let me show you the stats here about which videos are doing well. So these ones up here at the top. Okay, this is the stream, today's stream, yesterday's stream. Oh, no, this one was a short. This one was a short. So that short got a bunch of viewers at one point. CPI did okay. I'd like to see more like 500 to 1,000 views on shorts, but then you get into trading, computer hardware, order flow, and DOM trading. I'm really glad that that one is doing well, because that was one that we put a lot of work into. So that whole order flow series was like the magnum opus. So those ones are doing well. This price action trading one, that one's new, so that one's doing well. And then you kind of come down into, okay, these ones. This one, this monitor about the KVM switch, I kind of thought that that one was a bit of a dud, but it's actually, see, like, look at it. You see how, like, when it started, it was like well below trend compared to everything else, and now it's well above trend compared to everybody else. So I guess more people are searching about KVM switches than they are about order flow. Oh, you're right in ThinkScript and you're looking to move over. That's a good move. And NinjaTrader is way better to develop in C# than to develop in ThinkScript, for sure. Yeah, I looked through some of these videos because at the time, it's kind of funny, at the time when I made a lot of these videos, I was kind of like not very happy with how they performed initially, but then in the end, they have all performed. My channel is actually getting more, well, actually, can I do that? Let's see here. See more. Lifetime. People say liquidity and volume has dropped a lot. Maybe people are losing interest in markets and market content in general. Well, that's going on too. Weekly. So here's the chart of like all views on a weekly basis. So yeah, going into this time period, it was like the channel was really growing and I was happy about things. Some of these spikes, so like this spike is Bitcoin. That spike was Bitcoin. This one was the earthquake, I think. And this one was GameStop. This one was GameStop. So so when I look at my growth, this was the period where I felt like I was getting organic growth. This had more to do with the pandemic, right? And now it's kind of come down, but we have been seeing a slight growth in views. So like my new videos are getting out there, and I have like a wider and better array of content now than I did 2 years ago by far. So if something happened to where one of my order flow videos really took off or something like that, or maybe we had a moment on stream that went viral or something like that, right? We're like really set up for the channel to like really just explode in popularity. Like we're really well set up. But overall, it does seem to me that like interest in the market is most correlated with interest in our channel. And like more generally, I do see a lot of channels that just really outperform ours, and I'm really not sure why. So for instance, people were talking about Rocket Scooter. So I think that this is Day Trade Paradise. Okay, so he put a lot of like marketing and stuff in. Okay. But and I think that he just renamed his channel or something. I don't know, because otherwise I don't know how he got that high up. So maybe we can discount him. Probably Matt too, right? go to trading here. 10 watching right now. Filters live. Jeez. 788. Okay, so there you go. Like Matt gets 1.6K, right? But then you get some of these other ones. I have more subscribers than this guy, but he has 131 people watching and I only have 10. This guy only has 2,000 subscribers, but he has 33 people watching. How is that? How is that? Explain this to me. Pretty much every... So we want to look in here. There is quite a bit of competition for our viewers here now, and I'm underperforming all of them. And I think that my stream is 10 times better than all this other shit that's out there. Not calling Matt shit or anything like that, but some of these are shit. So some of these really are like, some of these really are just like an S&P 500 chart. So like let's come to like the top ones. Like this one, I think is just a. It's a chart. Well, he's speaking. He is talking. There is a guy talking. But it does have live trading. I have look at my title: Live Stock and Futures Order Flow Day Trading. CPI disaster. And then I have like my thumbnail and stuff. What's up? Explain this to me. What's wrong? What am I doing wrong? There's actually the see, the more I'm talking, the more people are like, yeah, I'm not so interested in you now, Seth. Because why? Because I made my money and I'm not doing anything now. And you want to shadow my trades? Is that what it is? Is it because y'all just want to shadow my trades? Yeah, a lot of those do trade equities, but even the ones that are trading futures, there's more. Oh, so let's come back. If I come back and I do trading futures, dump 100 contracts. You're right. I mean, we did have more viewers at the beginning, but they kind of quit. Right? So they didn't like something that I said, maybe. Well, Bookmap has a live stream now. Well, there's my problem. Is that Ninja Trader and Bookmap are stealing all my viewers. So here's one. The Bit Futures Trading, 2.67. He's got 20 people watching. So that's like more comparable, right? Well, there are some people below me that don't really have anybody watching at all. Oh, that's right. I recognize the pit now. Like straight up, the information that I have on this channel is well beyond what anybody else in the day trading, education, influencer space is sharing with people. It's light years ahead. Everybody else is still talking about bullshit candlestick patterns and stuff, right? But the issue is that people like the candlesticks, right? So I think part of my problem is I'm very critical, right? Like, as me growing up, was ADHD, and you know, for an ADHD person, a lot of people will think, well, you know, you're ADHD, you have a hard time thinking, like, so you need to give people a little bit more room. But it's actually, no, it's the opposite. Person with ADHD does better with more accountability. So my parents held me to a lot of accountability. They watched me, made sure that I did my homework and all that sort of stuff, like a hawk, right? So I think that I turn around and I kind of behave the same way as what I experienced, right? So I'm really strict, and I'm very critical, right? But that's not like what people respond to, really, is it? People don't want to be criticized. And so to come in and to say, well, price action is garbage, and if you're trading price action, what are you going to do? Are you going to come in and say, oh, maybe Seth has some really advanced knowledge that will help me in my trading and help me overcome the issues I'm having in my trading? No, that's not what they do. They say, but price action does work. Then they're going to try and justify why they should still be trading price action, right? You don't catch you catch more flies with sugar, or well, no, that's not the way it works. Anyways, so I kind of have to change maybe my tone on that. But the whole thing was just that, like, look, I went through that. The quintessential experience as a trader is this, and if you haven't experienced it, you're going to experience it at some point. I guarantee you. The quintessential experience as a trader is you're trading and you're starting to do really, really well. And then as soon as it seems like you're doing really well, everything falls apart. The signal stops working, you blow the account or whatever the deal is. And you come back and you look at it and you realize that all of my success from before was just luck, and that I don't actually know anything. That's the quintessential experience as a trader, and you're going to experience it multiple times. You're going to experience it multiple times, right? So I went through that too. I always started with order flow, but I basically applied technical analysis to order flow. That's what I did. And I would have periods where I would do really well, but then it would fall apart. I've had now this run that I've been going on, and I wouldn't say that it's like amazing profits or anything, but I've been consistent at least for over a year now. It's been really good, right? And there's little stumbles along the way. I still make big mistakes that I think we can get rid of, but it seems to me, I think I have good reason to believe that those mistakes had more to do with me rather than the way that I trade. Why it fell apart? Because risk? Well, no. Even if you have risk management. So the reality is that almost everybody in day trading is undercapitalized, right? Okay. But you would think, okay, I should have a daily risk limit so I prevent myself from hitting that daily risk limit, right? Well, but what happens when you lose 10 days in a row? It shouldn't happen, but I'm telling you what, man, it does. Totally does. Or it's just like it seems like a freak accident, right? So the ones where I made mistakes was basically me experimenting most of the time, where I was like, oh yeah, let's go and put an order in the 5-year this time, and I know that the liquidity is shit, but etc. And then those fall apart, right? Those have been the big losses over the last year. whereas the trades where I'm really focused and doing what I'm doing, I'm doing pretty okay, right? But what happens to most people? So what happens? You do the price action thing, especially, is you say, I'm gonna take a 4-tick profit and a 8-tick loss, right? And then you'll get this one day where you lose every freaking time. And then you're supposed to have a daily loss limit, okay? But maybe when that happens, it's usually a volatile day. So you'll catch slippage on it. So when I was doing those sorts of things, I never did skewed risk reward. My risk reward was always equal when I was doing these sorts of things. But I was trading a moving average, for instance, at one point, right? And I took a 10-point slippage on one MES contract. Literally just $100 slip, just like that. When I'm supposed to only be, losing 8 points at that time, something like that. 16, I think maybe it was 16. And then all of a sudden it moves 40 points just like that. Yeah, that's kind of what happens to you, right? And then you get into this period of the market where like it does that every day for like a month or two, and you get screwed. Because I tell you what, man, I've seen it so many times. I watch people. I pride myself on being able to remember who comes in here and see who's going on in the trading community and kind of keep tabs on them and see how they perform. And I see it time after time after time. You get these people that get really popular because they had their past success, and then all of a sudden one day, oh, I made a mistake and blew the account. Okay, well, why did you do that? For me, it was like I was trading a wrong instrument. I was trying a new trade, something like that. Okay, I don't really do that anymore now. But these guys, it was like they were just doing their trade. They were just doing their trading, and they think that they just made bad choices. But it's still like your usual strategy and stuff. So why did you lose? I don't think people realize that the strategy is destined to fail. The strategy, it puts you into those situations where all of a sudden one day it's going to, because it has a fat tail, and you won't be very prepared to deal with that fat tail. Blah, 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 blah. Right? So like 20 trades isn't enough if you have a fat tail. You might not see the fat tail until you're getting into 1,000 or even 10,000 trades. Right? That's why so many, so like those hedge fund blowups, right? Because they were not properly factoring in the fat-tailed nature of markets, right? And that's the thing that's kind of frustrating about it for me, is essentially where your profit and stop is and everything else like that has a greater impact on your performance than your actual edge. So if you're taking excessive risk, then you don't really know if it actually works. None of your performance in the past tells you anything about the efficacy of your technical analysis setup, because the profits were mostly coming from having the wide stop, right? That's why you're like, when you come into the time period where like that specific strategy does poorly, like you have absolutely no way to deal with it. Yeah, I took a $50 winner, JC. And I also took one on sim in the 10-year and made 1,000. I think I had max 3 contracts on at one point, but I took it off. I was a good trade because I took it off. Where did I get out? Here, I'll just show you. I just have to bring that column in there. So this first one right here. Oh, I lost a little bit more on it than I wanted, but it was below 09. So anywhere below 09 was good. But I got out at 08. 110.08 was where I got out at. Because I saw this stuff going on in the 6J, and I thought that there could be a chance that the treasuries come roaring back here, and so that was a good call. And then this was just, I mean, of course, you sell it. This one I'm proud of, because at 3.88, I saw an opportunity to hit, and I chose not to do it. And I waited for the market to kind of chill out, right? But then when the market had kind of chilled out, I could see that there was a pretty wide spread there in the 10 years still. And the bid that they were putting in was was like way down here. So I bid it all the way up to 3.95 until somebody hit me. And I just knew that because we're looking at 3, next rate hike is going to take us to 3.75, right? Am I remembering that correctly? And then the next one after that will be 50. And then the next one after that will be, so we're getting to 4.5. That's what the Federal Reserve members have been saying the whole time, is 4.5, right? So if we're going to push further than that, how can the 10-year stay below 4%? It can't. And that's how I was able to take that trade. That's all there was to it. So I'll say, okay, I'll take from 3.95 to 4. Boom, easy trade. I don't even think, did it go against me? Oh, I guess it says that I experienced 27 ticks of adverse excursion. But that was just, from the nearest bid being way below me. Well, once the robots came back in and the spread came back in, they just pushed right up. Now, I could have let that run, but I'm really proud of that entry. Anyways, so I did take some trades. Here's the thing, JC. I'm going to tell you, so I've been giving you guys a lot of good information here today, but this piece of information is the simplest piece of information that I can give you that will make the biggest difference in your trading. And I mean, this one it makes a really huge difference. This is something that can completely transform your trading. Okay. The more trades you take, the worse you tend to do. Is really what it comes down to. Especially when we're talking about these big moves, it's usually the case that the first trade is the best trade. You get the trade in like at the beginning as things are just starting, and you let it run, and then you take it off when it starts bouncing, when you see a liquidity hole, and that's usually the best move. Every move after that is usually not as strong. There's less money in it, right? And you just kind of get chopped around, and when you start playing that game, you take all these trades and you take some losers, etc. Whereas you could just come in, make a $50 winner, and then be done with it. So the reality is that the less trades you're doing, usually the better. I mean, if you can take the one and you can just hold it all day, that's another thing. If it's a trend day, it's going to be a trend day, you can just hold it all day. That's the best trade you're going to get. That's going to be like your Pareto distribution, the one where like 20% of the trades end up being 80% of the results, sort of a thing. That's why. It's because the time in the market is more correlated to profits than anything else. So yeah, I intentionally limit the number of trades that I take per day. And I know that doesn't make for a great stream, because most people that come in and are new want to try and follow somebody else and shadow the trades. And so they want to be seeing trade opportunities all the time, right? But really, in the long run, being really selective about your trades is going to be the thing that makes the biggest difference for you, okay? The number of situations, the situation where we really actually have an edge, where we can really effectively predict the future orders and know where it's going to go, those don't happen all the time. They're not actually very common. In fact, there's many times where you can go days and not have an opportunity like that, right? So if you are more selective about your trading, that's going to help your trading more than almost anything else. You add it to your long-term portfolio, huh? That's interesting you say that, because when I was thinking about this yesterday, I was thinking in my head, like, what if it's really bad? Am I gonna freak out? Is this gonna be like this big moment that we can stream and stuff that we could make a short out of? Well, the way that I reacted to it today was actually not that interesting. The way that I reacted to it was like, oh, I could have hit that. Oh, well, I didn't. Well, okay, whatever. It wasn't super. I didn't make it super exciting. But it was a bad number, and we got the thing that we got, and look. When I was thinking in my head was sell everything, take my whole portfolio, dump it. But then I was like, no, that's not actually what you want to do. That's not actually what you want to do. I'm concerned for the stock market in the future, here, because it's probably going to go lower. It's probably going to go lower, I think. But I'm also thinking that we're probably close to the end, right? The storm is strongest before the eye of the storm, sort of a thing, right? I think that it may be the case that this CPI is really bad, that the action that we see through the rest of October will be a little ugly, but maybe in November and December we can start to get to the end of this, and we might actually see inflation pass. I can only hope. Because if November is spot 6 again, and if December is spot 6 again, then now we're really looking at one of the greatest, strongest, and most destructive bear markets of all time, right? Is there a way to predict CPI or other events direction by analyzing price action or order flow into the event? Nope. So what you can do, if you watch the quote unquote price action into the event, if the news is contrary to the prevailing trend going into the event, then you tend to get a stronger reaction. That's something that I've back tested a number of times and I can prove empirically. But that's kind of like the whole thing, is that what you're seeing in the market right now is not very good at predicting what the news is going to be at all. I think we all come in and we think, okay, so everybody here is placing their bets on what CPI is going to be. So that should be able to tell us if CPI is going to be good or bad, right? So come back and look at the chart. Come back and look at the chart today. Here, we'll make this really big. We'll zoom in here. How much time we got left? We got about 10 minutes. We got time for this. Okay. Coming back. Okay. Here was before the news. What do you think? Based on this price action, should we buy or sell? Well, the trend is up, so we should go with the trend. That must mean that people are buying because they think the CPI is going to be good, doesn't it? Well, no, it doesn't. That doesn't end up being a very good predictor. Why? Well, because people have all sorts of reasons to be able to buy, and a lot of it has absolutely nothing to do with what they think CPI is going to be. So here in this move overnight, a lot of this was being driven by the recovery in gilts, right? So the recovery in gilts has absolutely no correlation to what the CPI is going to be, does it? Which kind of creates this sort of situation where you could potentially, I guess, I don't know if it was really such a huge factor here, as much as that the CPI was just bad, but them moving up means that when they move down, it's going to be just that much stronger. Or I said that before the news hit too, didn't I? Right? But some of it could just be, oh, I have to protect myself against the downside. Like, I don't think that the number is going to be bad, but I just know that the potential loss I could have is going to be this, so I need to protect myself, or maybe exit my position, or whatever it is that I got to do to reduce risk. And so those orders aren't going to be indicative of which direction CPI is going to go at all either, is it? Right? Like, it just goes back to the thing that we were talking about at the beginning of the stream, which is that when you try and look at people's behavior in aggregate and try and determine where the market is going to go based on like some sort of market psychology reading into how the market participants will react to the change in price, what you find is that people's reaction is really quite random. Right? Now, there are some situations where we can know, like, somebody's going to rebalance at the end of the month, or there's a really big options position on, there's, breaking news that comes out. There's all sorts of things that can potentially predict order flow, right? But when it comes to these economic numbers, and with CPI and non-farms jobs in particular, and probably consumer sentiment is, consumer sentiment I find is not quite as random, but it can still be a tough one. Okay. But CPI and non-farm jobs in particular are just really hard to predict for whatever reason. Like, the analysts aren't very good at predicting it, and the market isn't very good at predicting it, and yeah. On volatile days on key releases, you might consider elongating your ladders. Yeah, live action, maybe. I mean, in the S&P 500, I want to have things more consolidated, right? The next release of Jigsaw actually has a feature that may allow me to change what we see in the ES to make it. So I think that I will make it the same size as these ones over here, but you'll be able to see more prices. For the third time, I saw price spike up 1 to 3 minutes before the numbers release and then reverse to the other side. Yeah. Well, here again, you'll see patterns. I mean, the problem is that like the patterns will like kind of appear and disappear. So it's like, so we saw it for the third time. Well, think of it this way. Let me back up, okay? In statistics, when we are looking at a distribution, like we have a normal Gaussian distribution, you know, that whole thing, like, you know, the little device, I should buy one of these where it's like a little Plinko thing and then it shows a normal distribution, right? Okay, how many balls do you need to be able to see that distribution? Okay, 50. The answer is 50. To have a statistically to get a result that is statistically significant in a Gaussian distribution, you need at least 50 data points. Okay, so I think those things have 50 balls. What if there was only 10 balls in there and all 10 of the balls came onto the right side of the distribution? Does that mean that there's a pattern? And maybe you did that twice. Does that mean that there's a pattern? No, no. You need 50. You need 50. And then you can see the distribution. Okay, so it did that 3 times in a row. Yeah, maybe there's a pattern to it, but maybe it changes, right? And if it changes, does that mean that it was just random, or was something going on in it and just the conditions changed, right? There's no way for us to know. There's no way for us to know because we just don't have enough data, right? That's why I just kind of gave up on making those kinds of determinations, right? I try and base my trading off of things that I can really conclusively prove, right? Like I know there's no question about it in my mind at all. If CPI today comes out above 0.4%, the market is going to puke hard and you can just sell the treasuries probably just about anywhere within that first 15 minutes and make money. It's that simple because everybody's going to sell. And I mean, we all know it, but the framework that I put this into is that's a predictor of order flow. If CPI is high, it is going to be highly predictive of sell market orders coming into the market. And that's what I base my trading off of. And I no longer try and make these determinations off of, oh, I saw a pattern and, you know, is this a real pattern, and try and, because I did that for a long time and it didn't really get me anywhere. And now I understand why. The market is very statistically significant. So any kind of real pattern that was like a real pattern that existed for a real reason and was consistent is just going to be arbitraged out of the market. So for me to sit here and think that I can just see a pattern that nobody else in the market is really kind of, frankly, a little pompous of me, right? To think that I'm that smart compared to everybody else, right? It's gonna, you know, the market's gonna be efficient, and so it's really quite silly to think that I'm just going to watch the price move around and see a pattern that all of these other people that are spending thousands of dollars trying to find, that they're not going to see it and I am. You know what I mean? What I can do instead is I can know about the market, and I think that I can know more than other people in the market. I can certainly know more than other retail traders, and heck, maybe even some of these institutional guys, because they're not necessarily looking at like what is CPI likely to be necessarily. They're concerned with other things, right? Like valuing companies or you know, whatever their model is that their hedge fund does, right? And so they might, you know, there is this kind of place for us where we can kind of slip in and know as much as we can and occasionally pull something out. Well, okay, so NASDAQ killer, I'll show you again. Here's the two that I took. So I took one on sim and I took one live. The one that I took live, I made $50 on in the micro treasuries. So I took from 3.95 to 4. for $50. And then in the 10-year, I sold the 10-year around 110.27. Oh, so it's actually back to where I initially took my sell. That's funny. That's actually really funny. But I sold it here and I took it off somewhere below this distribution in 09 at around 07. So 2 really good trades. But the thing I'm particularly proud of is that the reason I was able to take that trade at 3.95 was that I just knew enough about the interest rates and what the likely trajectory was going forward here to know that anything below 4% is probably a little low. So pretty happy with that. Pretty happy with that. But there was a point where it was giving me 3.8 or 3.9. Could have made 10. I could have made almost 15 basis points at one point. Yeah, it was wild. Did ZN lag ES on CPI? No, not really. Like actually, so this was the thing that was a little crazy about it to me was that there was way more people out there with offers on the micro treasuries than I thought there would be. There was a spot, like I said, 3.88, so it's all the way back here. You can still see it. You see that 7 right there? I don't know if I actually would have been fast enough, but there was a chance to hit that. And then there was a chance to hit 3.92, and I was just kind of like, oh, no. And it came all the way up here, and then I was like, okay, now I can take a trade. That's how far it went. Look at that. That's just insane. That's just insane. But the 3.88 was the first amount that went. It could have been me. Could have been me. Why didn't I do it? Oh, well. Then I could have made over 200. That would have been crazy. But no, I was way risk averse, and I just took the 50. That's fine. But the ZN, I mean, if you come up here and you look at it, and good grief, look at it. So all of this, they skipped and then traded through. There was actually, where was it? I think it was 16, but was it this 16 down? I think it was this 16 down here. Yeah. So this 16 down here, there was a lot of volume that traded, and then it went through. So like that downtrend lasted for a while, yeah. And I'm sure that the backwash that you're getting there is like some volume coming into the 6J. Let's just come back over here to the charts and look at that real quick. So there was this spike in the 6J, but it's kind of moderated since then. I think we need to keep an eye on the 6J still, though. The Japanese might come in and do something again. That's why I got out of my sim trade, actually. Yeah, everything got killed. Like NASDAQ killer, it really was. We were kind of talking about it because, you know, like, what is this compared to previous ones, right? So if we come back to September 13th, that was CPI before, right? And if you can see where I have my cursor, there versus there is the range. That candle versus that candle. It was just a brutal move. Did I really? I caught 30%? If I had really gotten what I could have, you know, like I should never expect to get it perfect every time, but if I had played this perfectly and I really had the opportunity to, and I think that other days maybe I would have, but I was being a little bit averse because I knew how big of a deal the day was. That would have been more than 50% of the move. That would have been absolutely stellar. Yeah. You know what though? Here's another thing is that something that I always forget is that in this kind of movement, those order flow reads you can get really good order flow reads, man. Because for me to take the 27, so let's come back over here and look at my sim trade in the 10-year. So when we look at my sim trade, I took it somewhere around here, I think. I took it right there. Yep. It was 27. Yeah, no, it was right there. Let me do it in yellow. Let me verify the time here. I think it was at 40, not the other way around. Oh, it was 34. It was 34. So it was right here. So I took it on this hump right here, right? Took it on this hump, and then I think I took some profits and added onto it a little bit here, right? And then it went down. And then I exited right about here, right? So when you look at that on a chart and you see where I took my entries and everything, that's like about as good as you possibly could have done it, huh? For the sim trade. The sim trade was about as good as you possibly could have done it. Yeah, sometimes when you really can read the order flow, you can get really good entries in crazy action. But it's a fat-tailed sort of a thing, right? Like when you screw it up, you'll screw it up so hard. So you gotta be careful with those. Nice juice, right? What do you mean by juice? Anyways, it was actually a really good day of trading for me. I'm coming in here and I'm super critical of myself. But the reality is that I traded this amazing. So there's probably tons of other people. I wouldn't be surprised to come and see some price action people coming in and trying to trade in all of that chop and losing tons. You know, that happens to people. But it did good. What do you typically trade? Well, as of the last year, almost all of my live trades have been in the micro treasuries. I haven't traded a live ZN or ES contract in a long time. Yeah, no, I do. Most of my trades are live trades over here in micros. But I'm just really selective about the trades. And if I'm not doing well, so kind of what will happen is, like, if I think that things are moving around and I think that it's worth it for me to try and mess around a little bit, like take risk on, essentially. But basically, I can come in and I can say, here's a situation where I might be able to take risk on and make some money, but I know that it's a fat tell. So I don't want to do it with my live account because I know that if I screw up, it's going to be like I could make $10 or I could lose $100, and I don't want to do that, right? But I'll do it on sim over here because it's entertainment, right? And usually it works out. And actually, if you look at like all of my trades, like all of the trades, including the sim trades, then the profits that I've made this year are like obscene. It's like, you're looking at like 5 times your money sort of a thing. But it's, the way that I'm doing it is taking excessive risk. So it's not something that you want to on your live account. Right? How do you use Delta in your trading? Well, so if I were to look at it today, this is the last thing and then I gotta go, okay? So I like to see autocorrelation in order flow, right? So this right here, that's great. Price is moving down, orders are moving down. It's happening all at once. I'm seeing some people puke here and here, but cool. I'm seeing people overall are selling. Now this right here, don't like that. If I'm short, I don't like that. I don't like to see cumulative delta moving up. Now, it's not like they can't diverge and stuff like that. And especially on a regular day, it's going to be kind of shifty. So I don't want you to think, okay, if I'm seeing price move up and I'm seeing cumulative delta move with it, then I want to take a trade, etc., etc. It's kind of more like if I get into a trade and then I'm seeing cumulative delta start to come the other direction, I got to think about getting out, right? And that's exactly what I did. I got out like right there. Right? Was when I said, oh, okay, actually, the volume's a little bit different. Maybe I want to get out, right? But then there's another side, and this is more important. And that is this. What are we trying to do? Predict future orders. So cumulative delta is actually the thing that we're trying to predict. What we're trying to come in here is we're saying, okay, we have CPI. If CPI is bad, I think that cumulative delta will go negative by about 30,000 contracts, 30 to 50,000 contracts. Okay, so we started at 50K here at the top. Actually, it's more like 55. And we got all the way as low as 10,000. So that was a 40K change in cumulative delta. Oh, okay, so we got a pretty good, maybe we estimated it pretty good. We got the amount of flow that we wanted. That means we should take profits now. So I use cumulative delta as kind of a target or goal to say this might be a spot where I want to get out because I saw the amount of volume that I predicted. And you just kind of, I wish I had some way to like quantify it and like make a prediction and everything, but I just kind of do it in my head. I just kind of say, well, this is significant, this is a big day. So if it's a big day, it's probably going to be 30K. Usual average size move is between 20 and 30K. If there's not like something directly moving the market, then right now, if I got like a 20K change, like that's a good winner and maybe I want to take profits there. So that's how I use delta. What time does your volume start on your ladders? So I think that these are all set to their regular sessions. So like my treasury DOMs reset at the beginning of the pit session. And I have the reset set to the defaults in the treasuries at least. In ES, I have it set to 10 seconds, but in ZN, I have it set to the default 15 or 1.5 seconds or whatever it is. Oh, 2.5 seconds. Clear trade interval 2.5 seconds. Just the default. Okay, guys, time for me to go. I will see you tomorrow, Friday. Ooh, it's gonna be next week. Could be interesting, I guess. See what happens. In the meantime, stay excellent, team.